every single piece of the ethereal cloud, every artificial intelligence algorithm writing code, every streaming platform delivering movies, every bit of digital data you have ever generated actually lives inside a massive, heavy concrete building right here in the dirt.
Yeah, right here in the dirt.
Welcome to the deep dive. Today, we are, proving why the tech boom of the 2020s is actually just a heavy construction boom in disguise.
I mean, it completely inverts how you look at a portfolio. We spend so much time analyzing silicon wafers and software margins that we just forget the physical prerequisites of the digital age.
Right, the actual physical stuff.
Exactly. You cannot plug in a single server rack until you have moved millions of tons of earth, stabilized the soil, and poured a foundation thick enough to hold up thousands of pounds of concentrated heat-generating hardware.
Which brings us to the mission for today's deep dive. We are executing a talk ticker style breakdown for you.
Fast-paced, data forward.
Heavily opinionated and highly actionable. We are extracting the reality from a single, pretty dense earnings transcript.
Yeah, the Q4 and fiscal 2026 call for Eagle Materials. Ticker symbol is EXP.
EXP, and they dig up rocks, they bake limestone, they crush gypsum. I mean, it is the absolute definition of a foundational bare-knuckle business.
It really is. And because it is a bare-knuckle physical business, it serves as a flawless macroeconomic thermometer for you.
A thermometer, yeah. Because they can't hide anything.
Right. Software companies can massage their user numbers or, pivot their business models overnight. But a company moving millions of tons of physical material, they cannot fake regional demand.
No, you can't fake a pile of rocks.
Exactly.
Yeah.
Their earnings call tells us precisely what is happening with housing affordability, federal infrastructure spending, and the actual physical rollout of the artificial intelligence boom.
So we're going to rip through the headline numbers, dissect the underlying operations, decode management's guidance, and then give you a definitive verdict on whether this stock is a buy, hold, or sell.
Let's get right into it.
Yeah, let's look at the top line. So for fiscal 2026, Eagle hit record revenue of $2.3 billion.
Right.
That is a 2% year-over-year increase. And their Q4 revenue also hit a record at $479 million, which was, again, up 2%.
Up 2%, yeah.
And look, Wall Street algorithms see the phrase record revenue and they just automatically start flashing green. But a 2% top-line bump in this inflationary environment, I mean, that barely beats a rounding error.
It really is a rounding error. I mean, a 2% revenue increase means they are essentially treading water on the top line.
Just floating.
Yeah. But the real story, the thing you need to pay attention to, is the divergence between that top-line revenue and the actual bottom-line profitability.
Okay, lay it out for us.
Well, while they pulled in more total dollars than ever before, their earnings per share, or EPS, came in at $13.16.
Which is down, right?
Yeah, that represents a 4% drop year over year.
Wait, let me stop you there. So you bring in more cash through the front door, but the shareholders end up with less profit per share out the back door.
That is exactly what happened.
I mean, the immediate assumption there is that their margins are just getting totally squeezed by operating costs, right? Are they just spinning their wheels on a treadmill?
Well, if you look at the cash flow statements, the actual operational drop was much more severe than that 4%.
Oh, really? Worse than 4%?
Oh, yeah. The only reason it didn't look like a total disaster on the EPS line is because management aggressively intervened.
Intervened how?
They deployed a massive capital return program to artificially tighten the float. Management repurchased 1.7 million shares during the fiscal year.
Okay, 1.7 million shares. What did that cost them?
It cost them $382 million.
Wow.
Yeah, and by buying those shares and just retiring them, they reduced the total number of fully diluted shares on the open market by a full 5%.
Oh, I see. So it's like the shrinking pizza phenomenon.
The shrinking pizza.
Yeah, like if total profit is the pizza we baked this year is objectively smaller than the one we baked last year, right?
Right, because operations took a hit.
Exactly. But instead of splitting it 10 ways, management spent $382 million to basically kick a few people out of the room.
That's a great way to put it.
So now we're only splitting it 8 ways. Your individual slice looks relatively stable, even though the underlying pie actually shrank.
That is the exact mechanical reality of aggressive share buybacks. And when you combine those buybacks with the cash dividends they paid out, Eagle Materials returned $414 million directly to shareholders in fiscal 2026.
$414 million. That's a massive Band-Aid.
It is. And for a heavy manufacturing company to return nearly $500 million in a single year, that tells you two very important things.
Okay, what's the first?
First, their legacy assets are generating just massive amounts of free cash flow.
Right. And the second?
Second, they believe their own stock is the absolute most attractive asset they can buy right now, rather than, acquiring a competitor or just hoarding cash for a rainy day.
But look, that $414 million financial Band-Aid is covering up a very real leak in their profit margins.
It is.
And to find exactly where that leak is coming from, we have to split this company right down the middle. Because Eagle Materials isn't just one single cohesive business.
No, not at all.
It is essentially two completely different industries duct taped together under one corporate umbrella.
You're exactly right. So on one side, you have the heavy materials segment, which is cement, ready-mix concrete, and aggregates.
And aggregates is just crushed stone and gravel, basically.
Exactly, crushed stone. And then on the other side, you have the light materials segment, which is primarily gypsum wallboard, so drywall used in residential construction, and the recycled paperboard that encases it.
So it's heavy dirt and rocks on one side and light housing materials on the other.
Precisely, heavy and light.
Well, the heavy side of this business is just absolutely tearing it up right now. I mean, heavy materials revenue jumped 10%.
10% is huge for dirt.
Yeah. Physical cement sales volume rose 8%. But the number that just jumps right off the transcript for me is the aggregates. They moved a record 6.6 million tons of crushed stone.
6.6 million tons.
That is a 70% year-over-year volume increase. You do not see 70% volume growth in a legacy industry like crushed rock, unless like a massive tectonic shift is happening in the economy.
Well, to be fair, part of that 70% spike is inorganic.
Meaning they bought someone?
Yeah, they recently integrated several aggregate business acquisitions, which, obviously bolsters that headline number.
Okay, but even so.
Right, even if we strip out the acquisitions entirely and look strictly at organic growth, the combined underlying demand for cement, concrete, and aggregates still showed a 24% increase in sales volume.
24% organic growth. That's still wild.
It really is. That level of organic growth in heavy building materials, it requires a structural catalyst.
And that catalyst is coming from two massive, distinct spigots of capital.
Right.
The first is public funding. So the Federal Infrastructure Investment and Jobs Act is finally, moving past all the bureaucratic red tape and entering the actual dirt-moving phase.
State highway budgets are flush with federal cash right now.
Exactly. And that translates directly into long-term contracts for poured concrete and crushed gravel. But, the public money is sort of the slow, steady driver here.
It is.
The explosive driver, the one that really matters, is private non-residential construction, specifically this backdoor AI play we talked about.
Yeah, the data centers. The scale of modern data centers is, honestly, it's difficult to comprehend until you look at the raw material requirements.
Right, because people think, it's just a warehouse with some computers.
Exactly. But we are not talking about retrofitting a warehouse in some suburban industrial park. These are massive, purpose-built hyperscale facilities that span hundreds of acres.
Hundreds of acres, wow.
And before a single steel beam is even erected, the site requires extensive soil stabilization.
Yeah.
You have to carve out the earth and backfill it with millions of tons of aggregates just to create a level, structurally sound pad.
Because the servers are so heavy.
Right. And then you pour concrete foundations that are exponentially thicker than standard commercial buildings.
Yeah.
They have to support the extreme weight of high-density server racks, industrial cooling systems, and these massive backup power substations.
It is just an incredible irony to me. The entire tech industry is obsessed with virtualization, right? Like migrating to the cloud, reducing digital friction.
Oh, totally.
Yet the physical manifestation of the cloud is literally the heaviest, most friction-laden construction process on the planet.
It's just endless trucks of concrete.
And Eagle Materials is positioned exactly where these hyperscale facilities are breaking ground. They're effectively taxing the AI boom before the tech companies can even turn the servers on.
And that acts as an incredible buffer against macroeconomic weakness.
How so?
Well, even if standard commercial real estate like office buildings or retail strip malls completely collapses due to, remote work trends or high interest rates, the secular tailwind of data center construction and federal highway projects more than compensates for that lost volume on the heavy side.
Which is great, but that brings us to the other half of the company, right? the duct tape situation?
The light segment.
Yeah, because if heavy materials grew revenue by 10% and the total company only grew by 2%, then the light materials segment must be a massive dead weight dragging them down.
The drag is severe. I mean, light materials revenue dropped 9%, falling to $881 million.
Ouch.
Yeah. The volume of wallboard shipped was down, and the actual pricing of the wallboard dropped by 4%.
Okay, a 4% price drop in a highly consolidated industry like drywall manufacturing is a massive red flag.
It really is.
Because wallboard isn't something you innovate, right? You don't release like drywall 2.0 with cool new features.
No, it's just gypsum and paper.
It is a pure commodity. So a price drop means the underlying demand has just fundamentally evaporated. And we know exactly why.
Housing.
Yeah. The U.S. residential housing market is effectively frozen in amber right now.
It is. The lock-in effect of the 30-year fixed-rate mortgage has just completely paralyzed existing home turnover.
Right, because of the rates.
Exactly. Millions of homeowners secured 3% or 4% mortgages before the recent rate hikes. So with current rates hovering around 7%, those homeowners refuse to sell.
Because moving would mean basically doubling their monthly interest expense for the same house.
Exactly. And if existing homes aren't changing hands, the remodeling market collapses. People generally remodel when they buy a new house to make it their own, or, when they're preparing to sell it.
And new home construction isn't picking up the slack either. Builders are facing exorbitant capital costs to finance land acquisition and construction.
So they just slow down the pace of new builds.
Right. And if there are no new walls being framed and no old walls being knocked down for renovations, the demand for gypsum wallboard goes to zero.
Pretty much.
You cannot force a builder to buy drywall they don't need, no matter how much you drop the price.
No, you can't. But the 4% price drop is only half the crisis in the light segment.
There's more.
Oh, yeah. The other half is the logistical reality of how wallboard is actually sold. Eagle Materials operates on what is called a delivered basis pricing model.
Okay, wait. This is the pizza delivery problem.
The pizza delivery problem.
Yeah, so think about it like this. If you own a pizzeria and you promise free delivery, the customer pays a flat $20 for the pizza.
Right.
But if the price of gasoline suddenly doubles, you still only collect $20 from the customer, but your delivery driver costs you twice as much to fill up the tank. So the restaurant just eats the margin compression.
That is the exact mechanism crushing Eagle's millnet right now.
Millnet. That's Wall Street jargon. Let's translate that.
Sure. Millnet is the actual net sales price they retain after paying the freight bill. And gypsum wallboard is an incredibly difficult product to transport.
Because it's huge.
It's exceptionally heavy, yes, but it is also fragile and really susceptible to moisture damage. Because it is a low-cost commodity, the value-to-weight ratio is just terrible.
Right. You're shipping heavy, cheap rocks.
Exactly. You can only put so many sheets on a flatbed truck before you hit federal highway weight limits.
So you have a truck that maxes out on weight way before it maxes out on physical space, and it's carrying a product that sells for literally pennies per square foot.
Right. So the shipping radius is strictly dictated by the cost of diesel fuel.
If you try to ship drywall more than, a few hundred miles?
Yeah, if you go too far, the diesel required to move that extreme weight literally costs more than the drywall itself.
That's insane.
And management disclosed on the call that their freight costs spiked by $2 to $3 per delivery sequentially.
$2 to $3 a delivery, that adds up fast.
It does. And when the housing market is frozen, you lose the leverage to pass those volatile freight costs onto the distributors. The distributors simply refuse to accept a price hike because they already have inventory sitting idle in their warehouses.
They're like, we don't need it. We're not paying extra.
Exactly. So Eagle just absorbs the diesel spike, the millnet shrinks, and the operating margins in the light segment compress dramatically.
So demand is dead, prices are down, and the cost to ship the product is way up. I mean, it is the perfect storm for margin compression.
It really is ugly.
But, within this bleak landscape of the light materials segment, there is one fascinating outlier in the transcript.
The paperboard.
Yes. The recycled paperboard operations actually posted a record year.
Which seems completely counterintuitive, right? Because the paperboard literally encases the gypsum to create the final drywall product.
Right. They are stuck together, literally.
They are inherently linked in the final application. But the business model of the paperboard plant is completely isolated from the chaos of the spot market.
How so?
Well, 60% of their paperboard sales are governed by long-term supply agreements with built-in inflation pass-through mechanisms.
So they legally contract away their raw material risk.
Exactly.
So if the price of old corrugated containers, which is basically just the recycled cardboard they mash up to make the paperboard, if that spikes on the commodities market, Eagle doesn't take the hit.
No, they don't. The contract explicitly allows them to pass that exact cost increase directly onto the buyer.
Wow. That's a great setup.
It is. And they do the exact same thing for energy costs. The paper mill operates with incredibly high plant efficiencies, meaning their fixed costs are really tightly controlled.
Okay, so by hedging the variable costs of raw materials and energy through these long-term contracts, they effectively guarantee a stable margin profile regardless of what the broader macroeconomy is doing.
Yeah, it is a masterclass in risk mitigation within a highly volatile commodity sector.
So just to recap for you, we have a company generating massive cash flow from infrastructure and data centers, right? But they are bleeding margin on residential drywall due to frozen mortgage markets and diesel spikes.
Right.
And meanwhile, they are utilizing these incredibly smart contracts to protect their paperboard division. The natural question for any investor looking at this is, what do you do with the cash being generated right now?
That's the big question.
Do you hoard it? Do you buy more stock? I mean, Eagle's management is taking a massive $500 million swing on physical infrastructure.
They are. They are projecting capital expenditures, or CapEx, to peak in fiscal 2027 at somewhere between $490 million and $525 million.
That is a staggering amount of capital deployment, especially considering a current cost of capital and, all the weakness we just talked about in the residential sector.
It sounds risky, but they are executing a hyper-targeted strategy of modernizing their oldest, most inefficient legacy assets. It's defensive and offensive.
Okay, so the two crown jewels of this modernization push are the Mountain Cement plant in Laramie, Wyoming, and a legacy wallboard plant in Duke, Oklahoma.
Right, Wyoming and Oklahoma.
But upgrading a cement plant isn't like installing new software. It takes years of engineering, permitting, and heavy construction.
Absolutely years.
The Wyoming project is about 60% complete, and they're targeting a late 2026 commissioning. And the Oklahoma drywall plant is 30% complete, aiming for late 2027. So why pour $500 million into these specific facilities right now?
Well, to understand the return on invested capital here, you have to understand the thermodynamics of cement manufacturing.
Thermodynamics. Okay, get nerdy with it.
I will. So making cement requires taking crushed limestone and baking it in these massive rotary kilns that operate at upwards of 1,500 degrees Celsius.
1,500 degrees, that's basically lava.
It's incredibly hot.
Yeah.
And this calcination process chemically alters the rock, stripping away carbon dioxide to create clinker, which is then ground up into cement.
Okay, so you have to bake the rocks.
Yes. And heating a massive steel tube to 1,500 degrees 24 hours a day requires just an astronomical amount of fuel. Historically, they used coal, but increasingly it's natural gas or engineered alternative fuels.
Fuel is the absolute bottleneck of cement profitability then.
Exactly. If you are operating a kiln built in the 1970s, the thermal efficiency is just garbage. You're burning massive amounts of fuel just to maintain the baseline temperature, let alone process the raw material.
So management is explicitly targeting double-digit returns on these CapEx investments because modernizing the kiln line dramatically reduces the energy consumption per ton of cement produced.
You hit the nail on the head. They are swapping out outdated, thermally leaky systems for state-of-the-art preheaters and modern kilns.
Which lowers the fuel bill.
It lowers the fuel bill, it reduces the carbon emission intensity, it improves mechanical reliability so the plant doesn't have to shut down for unexpected maintenance, and it actually expands the total production capacity of the facility.
So you spend the money up front to permanently lower the baseline cost of producing every single bag of cement and every single sheet of drywall for the next 30 years.
That's the play.
But the timeline is the most critical piece of data for you, the listener, because this $500 million CapEx spend is a temporary peak, right?
Right. By mid-fiscal 2028, both of these massive modernization projects will be commissioned and fully operational.
And then what?
Management anticipates that their capital requirements will immediately plummet back down to their baseline maintenance run rate, which is roughly $150 million a year.
Okay, this is the free cash flow tidal wave scenario.
The tidal wave is coming.
Think about it. If a company is generating enough cash from operations today to comfortably fund a $500 million construction bill while simultaneously returning $414 million to shareholders, what happens in 2028 when that $500 million expense suddenly vanishes?
Right, when it drops to just $150 million.
Exactly. Assuming revenues remain flat or even grow, you have a massive expansion of free cash flow. That $350 million difference falls straight to the bottom line.
And it becomes available for deployment.
Yeah, given Eagle's historical capital allocation framework, that tidal wave of cash will almost certainly be directed into further aggressive share repurchases, dividend increases, or, targeted acquisitions of regional aggregate quarries.
But the thing is, they aren't just sitting around waiting for 2028 to fix their margins. No. Despite the choppiness in the housing market, management is testing the absolute limits of their pricing power right now.
Right, the price hikes.
They successfully pushed through cement price increases across almost all of their geographic markets on April 1st.
And even more aggressively, they announced a June 1st price increase for wallboard, specifically citing the need to offset those rising diesel freight bills we discussed earlier.
Now, raising prices on drywall when the residential housing market is practically in a recession is a massive flex of industry consolidation.
It's bold.
It really demonstrates the inelasticity of demand in the building materials sector. There is just no viable substitute for gypsum wallboard in modern residential construction.
Right, you cannot build a house without it.
And because it is too heavy and fragile to import efficiently from overseas, domestic builders are completely held captive by the local supply chain.
Eagle knows the distributors have no alternative. I mean, building a brand new drywall manufacturing plant from scratch takes years of environmental permitting, hundreds of millions in capital, and guaranteed access to raw gypsum.
The barriers to entry are just astronomical.
So high that existing players essentially operate as regional oligopolies. They can force a price increase through simply because nobody else can deliver the product cheaper within that specific geographic radius.
Exactly, which brings us to the synthesis of all this data.
Yeah, let's pull it all together.
We have dissected the top-line stagnation, the aggressive buybacks, the data center-driven heavy materials boom, the housing-driven light materials drag, and of course the $500 million bet on thermal efficiency.
So it's time for the ultimate talk tickers takeaway. For you, the retail investor sitting at home looking at the ticker symbol EXP, digesting this entire transcript.
Right.
Do we walk away from this earnings call with a bullish or a bearish signal?
Well, if you weigh the structural advantages of their physical assets against the temporary macroeconomic headwinds in housing, the verdict is unequivocally bullish.
Bullish, okay.
The foundation of this company is virtually unassailable.
I love it. But lay out the architecture of that bullish verdict. Give the listener the actionable thesis here.
I can do that. The thesis rests on three primary pillars. Pillar number one is what I consider the ultimate physical moat.
The ultimate moat. Let's unpack that because we use the term moat constantly in finance to describe software lock-in or brand loyalty.
Right, but Eagle Materials has a literal moat of rock.
A literal moat.
They control an average of 50 years of quarried raw material reserves located immediately adjacent to their manufacturing facilities.
50 years of reserves, and that is a staggering competitive advantage when you understand the mechanics of local zoning.
Oh, zoning is everything.
Because look, in the 1950s and 60s, you could just buy a plot of land outside a city and blast a quarry. Nobody cared.
Right.
Today, the regulatory environment makes it functionally impossible. The NMBY phenomenon, not in my backyard, ensures that no municipality will ever approve the zoning for a massive dust-generating, dynamite-blasting limestone quarry anywhere near modern civilization.
They won't. The regulatory capture of the heavy materials industry is absolute. Eagle's existing permitted operational quarries are completely irreplaceable assets.
Because nobody's making new ones.
Exactly. And because crushed rock is so incredibly heavy, a competitor cannot mine limestone 2 states away and truck it in to compete on price.
The transportation costs would just destroy their margins?
It wouldn't work.
Yeah.
Eagle owns the dirt right next to the city where the concrete needs to be poured. That localized monopoly practically guarantees their pricing power for the next half century.
Okay, I completely buy the regulatory moat argument. I'm with you on pillar one, but having 50 years of limestone doesn't matter if nobody's buying concrete.
That's true.
Which brings us to the second pillar of the bullish thesis. What is it?
The second pillar is the sheer velocity of the backdoor tech play. We've established that hyperscale data centers require millions of tons of heavy materials.
Right.
But the critical nuance here is geographic alignment. Management explicitly noted on the call that Eagle's regional footprints overlap almost perfectly with the most active corridors for private non-residential construction and federal infrastructure deployment.
Oh, wow. So they're exactly where the building is happening.
Exactly. Even if national construction data shows a slowdown overall, Eagle-specific localized markets are being heavily propped up by server farms and highway bridges.
The volume growth in the heavy segment is structurally insulated from broader consumer weakness, basically.
Yes. The data centers provide the floor. As long as the AI arms race continues between the massive tech conglomerates, the demand for soil stabilization and reinforced concrete slabs remains entirely decoupled from consumer interest rates.
Decoupled. I like that. But what about the light segment? The residential market is still frozen, right? How is that bullish?
Well, that leads to the third pillar. Investors are basically being paid to wait for the housing cycle to turn.
Paid to wait.
Yeah. The United States has a massive multi-million unit structural deficit in housing. The population continues to grow, household formation continues, and the existing housing stock is aging rapidly.
Right, the demand isn't going away.
The underlying fundamental demand for shelter is compounding every single day the market remains frozen.
It is a coiled spring. I mean, the moment the Federal Reserve begins a sustained rate-cutting cycle and 30-year mortgages drop back into the 5% range.
The math suddenly works again.
Exactly. The math for both existing homeowners and new home builders works. The lock-in effect breaks, turnover spikes, remodeling explodes, and the demand for wallboard just skyrockets overnight.
And while you wait for that macroeconomic trigger to release the coiled spring, you are holding a company with a pristine balance sheet.
Let's talk about the balance sheet.
Eagle have a net debt to EBITDA leverage ratio of just 1.9 times.
Wow, 1.9 times.
Yeah, in a highly cyclical, intensely capital-heavy sector like building materials, maintaining leverage under 2 times is practically a fortress.
They are completely insulated against a sudden credit crunch or a prolonged period of high borrowing costs.
They don't need to issue expensive debt to survive.
Yeah.
They use their massive free cash flow to fund their own capex, pay a dividend, and systematically buy back their own stock.
And they still have authorization to repurchase another 2.9 million shares, right?
Yes, they do. They are essentially using their data center profits to slowly buy up the company while Wall Street just ignores the stock because of the housing slump.
It is a textbook value accumulation strategy. I mean, it makes total sense.
It does. However, to maintain a truly objective analysis, we do have to highlight the primary bearish caveat buried in the transcript.
Right. Nothing is perfect. There's always a flashing indicator on the dashboard that could compress margins in the near term. We've covered the diesel costs for drywall transport. So what is the threat to the heavy side?
The vulnerability lies in their coastal markets. Yeah. While Eagle is predominantly a domestic localized producer, the demand in specific regions, namely South Texas and Northern California, vastly outstrips their local production capacity.
So they can't make enough locally.
Right. So to meet that demand, they are forced to import cement from overseas into those specific regional networks.
And importing a heavy commodity immediately breaks the localized monopoly advantage we just praised them for. You are suddenly exposed to the whims of global logistics.
Precisely. Management specifically flagged the Baltic Dry Index on the call.
The Baltic Dry Index. Okay, translate that one for us.
Sure. The Baltic Dry Index tracks the cost of moving major raw materials by sea on dry bulk merchant ships.
So ocean freight.
Exactly. And due to ongoing geopolitical instability, shifts in global trade routes, and rising maritime energy costs, ocean freight rates have been ticking upward.
So if the cost to charter a dry bulk carrier from Asia to California spikes, the margin on that imported cement just collapses.
Yeah. They either have to try and force another price increase on the California buyers who, might dock, or they just eat the margin compression on every single ton they import.
It is the single biggest variable cost outside of their direct control.
It won't bankrupt the company.
Yeah.
The domestic footprint is far too robust for that.
Right.
But if the Baltic Dry Index continues to climb, you will see a noticeable drag on profitability in those specific coastal regions in the upcoming quarters.
It is a phenomenal reminder that even when you are analyzing a company that literally digs dirt out of the ground in Oklahoma, you still have to monitor maritime shipping rates across the Pacific Ocean.
Everything is connected.
It really is. Well, we have torn this transcript apart from the 70% spike in aggregate volumes down to the thermodynamics of rotary kilns and the mechanics of a share buyback.
It underscores the fundamental premise that the most essential components of our economy are rarely the ones dominating the financial news cycle.
The glossy software platforms get the headlines, but the physical infrastructure dictates the boundaries of what is actually possible.
You cannot code a foundation.
And you cannot stream a drywall sheet. As we sign off, I want you to hold on to that opening thought the next time you hear someone hyping up the borderless, weightless future of the cloud.
It's all physical.
Every server rack, every cooling tower, every gigawatt of power required to train the next generation of artificial intelligence relies entirely on millions of tons of crushed rock and baked limestone being pulled out of the earth. Keep questioning the algorithms, keep looking for the physical realities hidden behind the stock tickers, and remember that sometimes the most lucrative investments are covered in 50 years of dirt. We will see you on the next deep dive.